And hey there, hi there, ho there. Hey, you guys, I want to do a quick video on fair value gaps, imbalance zones, talk a little bit more about the 30-minute time frame as well as the 15-minute time frame. I've been experimenting a little bit more with some of the smaller time frames. I moved from the 30-minute, or sorry, I moved from, the 15-minute or whatever and looked at some of the other larger ones, and I'd settled on the 30-minute fair value gap for quite a while. Today, and actually for a while, I've been trying to find smaller fair value gaps, and I'm going to explain why. I'm going to talk about some of the benefits and how this can help you, and also go over the 3 rules because we haven't really touched on those much. I mean, I touch on them every day, but I think you really need to understand these. I think if you understand these, you will understand so much more about the market in the easiest form, kind of the easiest package. So let's jump into this. I'm going to keep this as short as possible, short, sweet, to the point. And we are going to jump onto the chart over here. As you can see, basically, let's see here. Yeah, we'll do that. We'll move it all over here. Basically what you are seeing is you see that I have the 30-minute fair value gap. So you can turn on the time frame. You know how to use this indicator, this tool really easy, I'm sure. But then I also have this turned off, and it's just using the 15-minute candles. Now, when this candle closes, I'm sure we are going to have another fair value gap here. So it's 12:53, 7 minutes. When this candle closes, whatever the low of that candle is, that is going to be a new fair value gap that is going to form here. If we have the 30-minute fair value gap on, which we can turn on. If I go visible here, click apply, you're going to see kind of the differences, similarities and differences between the 30-minute fair value gaps, which 30-minute are these red fair value gaps, and then the green ones, obviously, so those are 30-minute fair value gaps, as opposed to the salmon is the red equivalent of the 30-minute, and then the blue is going to be the green equivalent of the 30-minute time frame. But I don't want to kind of muddy the chart too much. This is going to create kind of a little bit too much in terms of just riffraff, I guess. But what I want to do is, what you want to do is, you want to compare some of these different time frames, and I'm not 100% sure if I'm going to go with the 15-minute yet. But the reason I wanted to bring this up and bring this to your attention is because when we did go to these 15-minute time frames, you tend to see a lot more intraday fair value gaps, right? Once this reloads here and gets back on our chart, you notice if we zoom in here, look, we have one from yesterday right towards the close. We have one fair value gap that formed right here during Globex. Then we had another fair value gap that formed during Globex. We had another fair value gap that formed here during regular trading hours. This was, it was still pre-market. One of the things, though, with these, and why I bring up this being important, is because of the rules that we have regarding the fair value gaps. And if you don't have these memorized yet, I would memorize these. I have 3 rules when it comes to fair value gaps. First rule is, if a fair value gap forms in Globex, there is a very high chance we will retrace to that zone during regular trading hours. This is a slam dunk observation. Go back and back test it to gain a testimony for yourself. So what is an example of number 1? This right here, this fair value gap right here, this little square, basically, that formed at 3:45 a.m. Central Time. That is Globex. When that fair value gap formed on the close of this candle, we were very likely, we had a very strong probability that either during Globex or during regular trading hours, during this session, we were going to come back and retrace and likely either fill. I always say get to the 50% retracement, or even if it's not 50%, I'd say probably like a 38.2%. I know you're going to go, Cameron, where the hell did you pull that number out of? I pulled that number out of a Fibonacci. It's a Fibonacci number, 38.2%. So that would be like a retracement somewhere right in there. That use those hard rules, and you will see how often we find those retracements and those fills. So we got that one. Then we got another fair value gap that formed right here. Close of this candle right here. made this gap right in there, and I can zoom in a little bit more. What did we do once that fair value gap was created? Oh, boom, we hit that wick, and then we pushed up. We did completely fill it. We did push up a little further, but again, that fair value gap again filled during pre-market. We get down here, this fair value gap forms on the close of this candle. Boom. So we get that one. We come down. We have a KPL down here. We have our KPL zone, right? And what do? We get into there a little bit. We start retracing, filling some of that zone. We push up, we pull back. And then what do? We get the move through. And so we have that fair value gap completely filled. So fair value gaps, rule number one, that happens very often. Rule number two, if a fair value gap forms between the open and 12 p.m. Central Time, there's a probability we can retrace at around 10:30 a.m. Central, or 1 to 1:30 p.m. Central Time. This is a rule that is less probable of the three. It's probably the least probable of all three is what I meant to say. And it's dependent on factors like when did the fair value gap form? How far is it from the current market price? And are we in a trending or consolidation pattern for the day? So there's more room for interpretation with that particular pattern. What would be a good example of that? Well, this would be actually a good example. Nope, that's still not pre-market. That's not pre-market, or sorry, that's not during regular trading hours. This would actually be one right here. It's 6 a.m. doesn't count. Okay, we gotta find one. This right here would count, this 11 a.m. one, and it did fill. So this is actually a good example of how we did. And on the 15-minute time frame, we're gonna see more of these fill. But this zone right here started on this. This is the candle that created it. So you take the previous candle, you take the close of the next candle, and then that zone has formed. We created that on the drop here. We retraced into it, we filled it, we did drop, and then we actually did fully fill it. One of the big things, your big jobs will be with this is figuring out, does the creation of the zone, does the retracement halfway through indicate that it's just retracing and that's where it's a good entry for another short to take it down? Or is that a sign of, are we going to push back up like we did obviously on this day a few days ago? And the way that I interpret the fair value gap with deciding whether it's a gap that's created and we want to short the retracement, or if it's a gap that we want to buy a low or buy a consolidation and then buy the break through it, is really based upon the time of day. Time of day is really going to be important in that that puzzle and figuring those things out. But again, this is one of those rule number two zones. It was created during regular trading hours. We were in kind of a choppier, we'd already dropped quite a bit. That's another thing about that day. We had already dropped quite a bit. We were towards end of day. And so obviously the fact that we got that zone filled, it makes sense. But here's the thing, again, 15-minute time frames, these rules will be a little bit different than if you were looking at, per se, the 1 hour, the 60-minute zone, or if you're looking at the 30-minute zone, right? Then we're going to go to rule number 3 here. And rule number 3 is if a fair value gap forms after 12 p.m. and it was not retraced to during the session, and it's within 1 to 2 ATRs of the closing price, there's a high probability you'll see that retracement right away in Globex, or you'll get that retracement in regular trading hours. And I try to post these, quite often. If you go into main chat here, just yesterday, I posted this one right here. We'd created this 30-minute gap. We came, we pushed up. What do we do right during the open of Globex? Boom, we retrace to it. So this rule number 3, this is a classic one. This is a cult classic. You can see it right here. This zone right here was created here right towards end of day. Boom, we pushed up, we came in, we even completely filled the gap before getting that push up. So there's an example right there. See if we can find another end of day gaparoo that was similar to that. This is a great example right here. These are very common. These ones, like, this is also like high probability, especially on the first touch. If you really look back on these, first touch is going to usually be a bounce. Again, do the math, get the percentages down. This is something you can quantify. You can use statistics to get good scalp plays. And this is a great example right here. We created this zone. It was after 12 p.m. Central time, and we had that zone created. We popped up, we pushed up, and then what did we do during Globex of the following session? Came back down, pushed up, and then we did obviously end up filling it and got that. So that was an example. We'll see what happens for the rest of today, but let's go back. We'll see if we can find one more here. I'm gonna do this, give you just one more example. We already talked about that example, but here's another example. On Sunday session, so this was the Friday close, we got a gap up, we got a gap, created this fair value gap right here. Bada bing, bada boom, we retraced to it once, pushed up. That would have been a great buying opportunity. Less probable to buy the retracement on a second touch, right? And then we still, though, we still did get that push up one more time. What did we push up to? Oh, interesting, right here, the KPL, right? And then from there, we got that drop down and we broke through the fair value gap. Super helpful and super helpful. I mean, this is an additional strategy that you can add to your repertoire, but it can also help you with trading KPLs. These algorithmically developed levels are key. But one of the big things is you can use these fair value gaps to help enforce your trading, enforce your learning, enforce how you are going to be more profitable. And sometimes, here's another great example. Again, this is rule number 2, right? We're creating this intraday. This is inside of the market, the regular trading hours. We created one gap, created a second gap, a double stack, right? And then based on time of day, right? We're getting to 11:45, 12 o'clock, 12:15 Central. What did we start to do last couple hours of the day? We pulled back, we filled those gaps, we retraced, and then we got the push up. But you are going to see very often, one of the things with these smaller time frames, I guess, in wrapping kind of this whole presentation up for you, smaller time frames, you're going to see where it doesn't hold the gap nearly as well. So what I mean by hold the gap is if you saw this on a 30-minute, which I guess we'll wrap this up by showing you the 30-minute time frame here. I'm going to turn off the 15-minute and turn on the 30. We're going to go visible. We're going to turn that off. We're going to turn the 30-minute on. We're going to hit apply. We're just going to actually hit OK. With the 30-minute gaps, you're going to see that it holds the midpoint of the gap much better. This one did wick down and take it, but the middle of the gap is going to be much more likely to hold, or the top edge. I know and what do I mean by that? We're going to have to zoom over here a little bit for me to point this out. But midpoint of a fair value gap. So that's like the midpoint or the middle. You have this little dashed line. You can kind of see right here when they're not filled gaps. But on 30-minute gaps, you're more likely to see like a retracement here, or for example, as we're pushing up, you hit the lower level and fine rejection, or you hit the middle and fine rejection. You're less likely, again, this is another good example, 30-minute gap, we hit the middle of that zone, or again, 38.2%, that's more likely. And then you finally get this barely getting to the bottom, filled that entire gap, pushed up, and kind of was chopping it out. But that was about a middle of this red gap right here. On the 30-minute, and as they get larger, you're going to essentially, my point being here, you're going to start seeing more of the gaps be more precise, as opposed to on the 15-minute or going to the 10-minute or the 5-minute. If you go smaller, the lower the time frame, the more it's not going to like hold the middle or hold the edges. But the benefit of the smaller time frame fair value gaps is that you're going to get more of those rules that we just talked about. I'm going to go back here one more time to recap these. The more you go to a lower time frame, switch back over here, video library, the more you go to a smaller time frame, the more these rules are going to pop up intraday. And so the more trades you're going to get. And obviously, the quicker you're going to spot the fair value gaps, because on a smaller time frame, it's quicker. Obviously, right? So these rules are huge. These rules are game changers for me. They have really helped enforce my trading, made it better. And not only that, you can also create an actual strategy based just off of fair value gap. So I hope that was helpful. If you have any questions, you can always reach out and ask me. Maybe I'll post the link to this free indicator. It is a free indicator in NinjaTrader. So I'll add that in there. It's already in our chat, and everything. So if you don't have it, you're missing out. But for anyone that does not have it, use this indicator. It is extremely helpful. There is an equivalent on TradingView, which again, I just love. I love this idea of imbalance zones, fair value gaps, whatever you want to call it, tomato, it is all the same. It is an imbalance of price action that occurred at a zone where not all of the auctions work. It's an incomplete auction. Basically, there is an imbalance between buyers and sellers at these zones. That is what is creating them. And because of that, price has to retrace to balance itself out, to equalize it. Just like you got to blow your nose to equalize your ears in the water. The market, if it blows out, it's got to go back to equalize things out. And it is extremely helpful to me. And hopefully it helped you. I'll catch you in the next one. Thanks for watching. Bye, you guys.